So if anybody wants to ask a question today, just put it in the chat. I'll try to leave time at the end to answer any questions if they come up. Purpose of today is really just meant to be educational. Hopefully, you can take it, do it yourself, work with a existing financial advisor, or if you want to learn more about our team, you'll get access to that at the end as well. All right, I'm going to go ahead and share my screen and we'll get going and we'll admit anybody else that's running behind. All right. Well, welcome everybody to the retirement planning workshop. I have to put the fine print. Today's educational, so if specific advice, you obviously got to go to a financial advisor or your accountant for advice specific to your situation. Before we dive in, just kind of the topics we're going to focus on today and the reason behind them. This actually just came out last week. I had a call with eMoney. I thought it'd be timely and prudent to put in here. But really just looking at, okay, what are retirees looking for, and then what services are people being delivered on when they engage with a financial advisor. So investment management, I mean, that's common. That's what everybody would expect. I say it's, a commoditized service. If you're meeting with a financial advisor, you would expect investment management. Surprisingly, 90% of people want estate planning and only 22% of them are getting it. So we'll just briefly touch on estate planning, but also we're focusing on that. Tax planning, which is a heavy emphasis of today. 89% of people would like some type of tax planning. Only 25% are receiving it. Charitable planning, almost everybody wants charitable planning, and that's the lowest scoring one. Only 6% of advisors are focusing on that. And then lastly is wealth protection planning, wealth protection strategies, the second lowest scoring. Also the lowest in demand as far as what people are expecting, but it's also not being delivered on. And so when it comes to how we've built our firm and a little bit about Revolutionary Wealth before I get into everything else, essentially what we do is we do wealth management. We do manage assets. We lead everything from a financial planning perspective, a financial planning approach. So how we make recommendations is based on a fiduciary financial plan. And then we try to tie that together with tax planning, estate planning. If somebody owns a business, we also do business consulting as well. So we've really essentially built our firm to be able to offer anything and everything to everybody. But the most important piece is that everything connects, everything interconnects. So just depending on who you are today, if you're just a normal retiree, pre-retiree, I have something for you. If you own a business, you're high net worth, there's also something in here for you today too, so you don't have to check out and say, hey, none of this applies to me. So we've got a little bit of everything that we're going to touch on today. What our firm looks like. So there's me, I'm a partner of our firm. Jorge's our other partner. We have another financial advisor, Jacob Patterson. Donna Tilden on our team is also a financial advisor, but she's also like our group benefits Medicare specialist. She has 30 years of experience in this business, but primarily she did a lot of high-level group planning, setting up 401ks, things of that nature. And then we also have a JD on our team, Liz Munoz. Our back office and our resources. So we're independent. We have an elite network of 250 advisors across the country, where we just get specialized capabilities. Essentially, we can handle assets and we can do complex estate planning for anybody who's really worth even over $1 billion. So we have unique capabilities through Lion Street. So Michael on our team, he's a CFP, CLU. He's our advanced planning and case design. And then if we have any insurance planning, Tiffany helps us with underwriting. And then we do have a CPA on our team, Armin. So that's an affiliate relationship. We did so much business with her that we just decided to come together. She handles our tax filing compliance. We can file taxes for people. If we're doing Roth conversions, complex business and estate planning, we just work across that with our mean. Obviously, if somebody has a CPA, we can work with them too, but sometimes it's easier just to have everything in-house. So the other thing I'm just gonna just preface, getting into this is we live in a world of extremes, right? And so You win elections based on extremes, the right, the left. You sell books on extremes. And that's just not how we run our practice, and that's not how we look at financial planning. The world today is either or. So, I'll pick on annuities. So it's either annuities are terrible or annuities are great, or alternative investments are great or alternative investments are bad. But really, the actual truth is it's a both and. Now, you can eliminate things through planning. I tell people I'm a believer in math and logic, and that if you believe in math and hate taxes, we're probably going to enjoy time together. Because that's how I look at everything is, we've had clients that one thing is terrible for them, and we're helping them get out of that position into something different. But then at the same time, that same position that wasn't good for them is good for somebody else. And so just have an open mind today, because a lot of times we're formed through all this content that gets thrown at us, and it's easy to get moved into one opposite idea and think that, oh, there's only this one path, when in reality, everybody's different. And so it's called dialectical thinking, which is how we really operate and process issues for clients. So the key problems that, most retirees are facing that you're probably already aware of and thinking, which is market volatility. If 2008 happens, what's my exposure? One, what's the cost of advice? Any more people, they walk in, they meet with a financial advisor like myself, and it's like, hey, you're going to pay 1.5% whether you like it or not. And there's really no way around that. But they don't see the value. It's like, okay, what am I getting in exchange? So I do think that's one thing that is getting overlooked, maybe, but a lot of it, retirees are expressing it is, am I getting my value for what I'm paying for advice? And I feel like that's also kind of dipping into estate planning with attorneys as well. And we'll talk on that a little bit as well. Longevity risk, are they at risk of running out of money if they live too long? Or if you outlive a spouse, we work with a lot of widows. That's a big market of ours, widowed and divorced women or men. And so will you outlive a spouse, and are you at risk of running out of money in that case? And then Social Security, healthcare costs. When do you take Social Security? How do you address long-term care and rising health insurance costs? So these are all things we're going to touch on today. But we're also going to focus on the things that are getting overlooked, in my opinion, which is number one is taxes. A lot of people dismiss, and I'm going to go into the methodology of where I believe people are overlooking taxation, and where that comes from. But the bottom line is, in thousands of client interactions, what I've found is taxes erase 0.5% to 2% of annual compound growth rate over your lifetime. And so that's a real rate of return. And so when you think about inflation and you think about healthcare costs, you can't totally eliminate some of that risk, but you can insulate some of it by having a proactive tax plan. But a lot of people, they wait too late, and then there's not a net positive to it. Estate planning, probate's costly, and a lot of people, they say, oh, I'll get around to it, I'll get around to it, I'll get around to it. To give, retirees grace, maybe you're in this camp, you walk into the attorney's office and you get sticker shock. And there's a rhyme and a reason to that, and we'll go into that today as well. But estate planning is really something that's getting overlooked. It's not executed on timely. People are waiting too late. The other is aging financial advice and private equity. Yes, I'm biased. Yes, I've been doing this a decade, but I'm only, about to be 29 years old. Yes, I'm biased that I have a competitive advantage over somebody who's 55. Yeah, they've been in the business maybe, a little bit longer than me, but I see the issue that a lot of financial advisors are golfing 3 days a week and giving financial advice 2 days a week. That's a problem. When it comes to taxes, estate planning, some of these unmet issues, we got somebody else joining us. The reason they don't care is because it's not their problem. They're not going to be in the business for another 5 to 10 years, or if they start helping you with Roth conversions, things of that nature, they're not going to be around to see the full effects of that. So they do not have an invested interest per se. And then the one thing you may or may not be familiar with is private equity has moved in pretty heavily into the financial planning space. As what private equity is good is they find business models with recurring revenue. Well, if an advisor is charging people 1 and 1.5%, that's recurring revenue. So what private equity is coming in is they're coming in and trying to eliminate people like me, who are not owned by private equity, from taking over smaller financial planning operations. They come in and offer financial advisors who most of the time do not have a plan for their own retirement. They give them a crazy sum of money and then they water down the product offering. And I think that's just a risk. I think that's something people aren't aware of, that we're intimately aware of. And then lastly is the cost of cash. A lot of people are sitting on cash or sitting in CDs. Those rates have been good. Rates are going to go down, but cash, gets taxed inefficiently. And ultimately, what I will share on a personal note is, my grandmother, my mom had me when she was 40. My grandmother's still with us. She has turned 90. She was born on the back end of the Great Depression. So a lot of her financial planning I missed out on, even though I've been doing this almost a decade. And what I will say is she just naturally kept money in cash, CDs, because that's what she knew. That's what worked in the late 80s when interest rates were high. And what I have just seen personally is, she's doing fine. My parents are taking care of her, but her cost of care, the things that she could, I'd say, have had alternatively from a planning standpoint was a cost of cash. Had that money been invested in equities or some type of asset class, I think her lifestyle would be different at 90. And so I'm impressing that upon widows and the people we work with is we want to take calculated risk, but we need to get some good growth rate over a long period of time to take care of you just in case you're by yourself in the future. So quickly, what if you're not familiar with RMDs, I won't spend too, most people are familiar, but understanding required minimum distributions and the ages, sometimes people aren't clear. They think it's still 73. If you're born in 1959 or earlier, the government's going to start making you pull a factor or a percentage, each year at age 73. And then if it was 1960 or later, so it's going to go to age 75. So you have an increased window for some tax planning. You have that 2-year addition. Typically, what I tell people, if you're doing it yourself, if you're going to leave it here today, and do your own planning. The typical round number is 4%, but there is a factor based on age. But an example being, if you had $1 million in an IRA and you took a 4% withdrawal as your RMD, it's going to be 40,000 a year tacked on as taxable income, as ordinary income on top of Social Security. Now, what I'm going to give you is a little, I used to do everything by hand back in the day. And so what I am going to give you is what they still come out with it every year. It's called a fast fact sheet, a fingertip tax guide. I'm going to give that to you to Google and you can download it yourself. Just in case you do your own stuff, I'm just going to give that away to you. And that actually I will show you. It gives you the factors and they update that every single year. So, and there's multiple companies, but I just use John Hancock's because it's always pretty up to date. So RMDs, the amount the government's going to make you pull, it gets taxed at ordinary income. Now, here's the problem. When I bring up RMDs and taxes, what I find when I talk to retirees and pre-retirees is they associate and they think about planning based on today and in a short-sighted manner. And that may not be you, but a lot of the people we've met with, we've had to rethink how RMDs are going to work. And so when they think about their risk, they think of it today. So they say in this example, hey, I've got $500,000. My perceived RMD risk is 4% of that, so 20,000, because they're not thinking, hey, I'm not going to be 75 for another 15 years, but their placeholder of how they're thinking about their risk exposure is based on what the balance is today. And where that originates from, I just call it looking forward versus backward. When you've filed your own taxes or you have a CPA, when you've traditionally done tax planning, you're conditioned to look backward in time. So you file and say, okay, what can I deduct based on the past, and not versus, hey, what's coming ahead in the future? And so what happens is even if you go to your CPA and ask for Roth conversion advice or something, a lot of times they're not apt to give you that advice because they're thinking today. They're thinking, hey, I get paid to reduce the return today. I don't really want to, they don't have any method or calculation to amortize what that's going to be in the future. And so you really have to think, especially if you're doing this by yourself, you have to think, okay, what is a, growth rate that I would expect? What's that future balance going to be? And what's the RMD risk based on that? So you could use an investment calculator to do that. You could, sometimes I tell people even just times 1.5 to be conservative. But a lot of people drastically underestimate the impact of compound interest and the effect it's going to have on a portfolio in a good way the older you get, because once again, we're always taught that the market's going to explode and we're going to lose all our money. And that's, what they tell everybody. But the bottom line is 85% of the time, the market's up and to the right. And so you have to think proactively and say, okay, how do I get ahead of this risk, knowing that basically I'm in a business partnership with the IRS and they're going to get a cut of my assets if I do not plan accordingly. And I want to be as strategic as possible. Which then leads to, if you think, oh, we don't have a problem, we all have a problem. The national debt, I meant to look that up this morning because I'm sure they've spent more money since I did this. But it's astronomical. If I don't know if you've ever heard, but you should Google this sometime. If you took the 36 trillion, if you took that in seconds and you reversed it in time, it would take us back to the Stone Age and beyond. We lose track of the perspective of how much money we owe and what it's going to take to keep up with it. And the only way, we keep making up things. And not once, I think the tariff thing, if they can make it, maybe that'll work. I do think there's creative things with AI, and I think we need multiple solutions. But at the end of the day, if they keep kicking the tires down the road on what we're going to do to solve our debt, the number one option is to come to the U.S. taxpayer, because ultimately we're the ones that they go to for everything when they want to spend money. And so we have to realize, okay, this is a crisis. It's not the thing that gets talked about in the news because it doesn't sell. But it's a problem. And essentially, the statistic for a long time was that tax rates had to double by 2030 before we go insolvent. I really think it's going to be 2035 now is kind of the window. And so I would say you have a window here if you're doing it yourself or you're looking for advice. We have about 10 years to get money drastically shifted into tax favorable environments, because eventually things are going to come to a head between the debt, Social Security, and our unmet obligations. So it's a crisis, it's a problem, and people are overlooking it. Historical tax rates were at historically low tax rates. They just got extended again. While I think it's great, like we should all be clapping and excited because it creates opportunity for all of us today, we should also say, hey, this is a warning sign, because in theory, taxes shouldn't have got cut. If we were looking at operating like a business, taxes needed to go up, not down. And so if we're going to have tax rates go down for a period of time or stay the same, that only compounds the problem we're talking about. And so that creates this opportunity here of, okay, what options do we have to strategically get money into tax favorable environments, do it at a historically low rate? So the first option we have, and this is, you're probably going to roll your eyes and say, okay, tell me something new, is Roth conversions. And so essentially what this is and kind of the methodology behind of where, okay, where is this a fit? One is just strategic annual shifting. And the key word is strategic and annualized. There's a lot of people on the internet right now saying, get all your money out of your 401k, get it out of your IRA. That's just not how it works. Like if you strategically if you unstrategically moved all of your money into a Roth, you're going to pay way more taxes. It's going to create a multitude of issues. And statistically, you're probably not actually going to save money on taxes. So what we have to look at is, okay, what is the roadmap? Okay, each year, how much money based on my tax bracket can I pay taxes? Because you're going to have to pay taxes. And in the future, am I net saving taxes by doing an annualized shift? And so that's why if you're younger listening to this today, if you're 60, 59 and a half, you have an unlimited opportunity between now and 75 to do some great annualized shifting, not everything at once. If you're a little bit later, and I'll show you some of the math behind just how this impacts based on real data, you have to get creative, but we don't want to do these, upfront shifts because at the end of the day, typically the math says we're not actually saving money on taxes. And it's timely because we got to get it done by the 31st of each year. Being proactive pays, like I just said, the earlier you are, I'm going to show you the real data on that based on real client interactions, how much money that can save you. And then a proactive legacy plan. Some of you may not have children, grandchildren, but some of you also may have had a parent pass away and you were subject to that 10-year rule, which is not fun. I've never had anybody inherit an IRA that we work with, and they're just excited to spend money over 10 years, whether they need it or not, to pay taxes. Now, some people, they credit card debt and stuff and they need to pay it off, but most people, they're like, oh, this is really inconvenient. And so also having a plan to say, hey, what's the tax liability after I'm gone? Do I want to make my dollars as efficient as possible from a legacy standpoint? And so it can be a great ta wealth transfer tool as well. So I'm going to give you the two variables to test for Roth conversion suitability. Because once again, we can play this game of theory and, is it good? Is it not? Because some guy on the radio says it is, or they say it isn't. But the reality is, when it comes to financial planning and a fiduciary perspective, there's only really two variables to test. And number one is lifetime net tax savings. And then the other number two is portfolio value at life expectancy. So when I'm running a financial plan for somebody, I'm rolling it into the future and I'm saying, hey, one, are they at risk of running out of money or not? But if there's a projected amount at a conservative rate of return that's projected to be left over, does Roth conversions positively or negatively affect that? Because it's not one size fits all. And if you don't do them correctly, you will lose money. And I have this example, as a hypothetical down here where it's done poorly is, you walk into a financial advisor's office or you calculate it yourself and you're like, oh my gosh, this is going to save me $500,000 in taxes. Well, depending on your age, and your current portfolio value, if that 500,000 then costs you 750,000 in lifetime portfolio value, well, you actually didn't get any value from Roth conversions. It cost you $250,000. So you have to be careful, and I hate to add more, things to the weeds, but this is where I think hiring a professional to do it is important, is you have to see it through these two lenses, because if it's done properly, when you're sitting down and you're doing the math, it should be a plus effect. It should say, hey, we're saving 500,000 and that taxation savings is now going to compound and it's going to grow over a period of time. And now my 500 turns into $1 million because it was money I kept in my pocketbook that got to be invested over a period of time. So now it's 1.5 million in total value. Now, the caveat to where it's done poorly, the minus 250 is once again, if it's not, if this is money you're never going to spend and you really don't care about it and you just want your kids to get as much money tax efficiently as possible, I guess that's the exception. But to me, that there's got to be margin there. And it's like, okay, maybe a little bit you're willing to give up. But there are people that sometimes it's six figures, or even seven figures we've met with that if they did conversions, it would cost them that much value in their financial planning. So you just have to be very careful, and make sure that, you're not too exposed at the end of the day. Here's the cheat sheet. You can take a picture of this if you'd like, for your own records, but this is based on real data, based on us meeting with clients. This isn't hypothetical. Is what I have formulated is the value and the understanding of where the potential for Roth conversions is based on, both IRA balance, but actually most importantly, what I find is age window. And so if you're between the age of 59 and a half and 64, the average we're saving people on taxes is $850,000. So it's pretty significant. 65 to 67, it drops to 465. And a little bit of a typo, I guess it should have been 68 to 70 is 225. And as you can see, from 70 to 73, it's 50,000. I tell people, and if you own a business and you're watching this, I have a creative strategy if you're over 70 to show you, or if you own real estate, a way you can kind of get around some of these, the 50,000 number. But the bottom line is this is just kind of what we've tested and what we've seen play out in real life for clients. So the younger you are, the more lucrative it is, really, regardless of account balance, even if you only have three, four, $500,000, it's usually six figures in tax savings. Because once again, if you're 60 and that money cooks for 15 years, you're going to have, quite a bit of time. And so, for that money to continue to compound and grow, so your savings is going to multiply. And so, one, focus on, okay, what's my age window? And then the other side is, okay, what's my IRA balance? And so if you have 1.5 million, or more, you can typically save 1.2 million, on taxes. If you have $1 million, 750. And as you see, 200,000 is the watermark there. In all the emails I was sending, that I said this is for people with $200,000 or more. That's another thing I don't hear people say on the internet is the kind of minimum threshold for Roth conversions. Just once again, from real life experience, is if you don't have over $200,000, Roth conversions usually has a minimal effect when it comes to tax savings. If somebody had $100,000, they may save $25,000 in taxes, for example. And to me, the margin for error there, depending on market performance, is they may actually lose money on that Roth conversion. So really, if you got to have more than $200,000 in a 401k or an IRA for it to make sense. But there is this illusion that, like, oh, if you have too much money in an IRA, that you can't do Roth conversions and actually save money. That's actually the complete opposite, far from the truth. And once again, this is based on just real numbers, real client interaction. So take a picture of this. Maybe this will help guide you if you're one to do it yourself, and you can back into the numbers yourself as well. And then getting into the specifics. So what I shared earlier, and some of you may have missed this when you joined, but what we have found is through actual planning is that Roth conversions adds 0.5% to 2% annualized rate of return to a retiree's portfolio. And so that's measuring the compound annual growth rate and the after-tax rate of return. And so this was actually a real client. So we did a Roth conversion on both spouses. And then we also did a RILA. I'll tell you what a RILA is if you don't know here in a little bit. So we just did a tandem of those. And what we found was, and you should be able to see it okay, is before the projected, compound annual growth rate was going to be 5.34% at age 85, and the after result was 5.83. So they did gain that 0.5% compound annual growth rate, but then the after-tax rate of return, or the annual rate of return, I mean, went from 3.61 to 5.12. So the older, and I didn't even go further because it gets even wider when somebody gets into their 90s. And so what we have found is, yes, the first few years of retirement, you're not going to see that difference because you're paying that tax up front. But later on in life, and you're basically starting in your early 80s, you're going to start to see these pretty big spreads on rate of return because it's money the government's not capturing, and you're starting to get that compound effect on that money that you paid taxes on earlier in the planning. And a lot of people say, I've had some cynical people say, oh my gosh, $250,000 at 85, who cares? Well, you don't get to keep, I'll say the millennial term here. You don't get to keep that energy of, oh, it's only 250, but then complain about healthcare costs or other things, because that 250, going back to my grandmother's example, that's the difference between quality healthcare, quality care. Like, some of those things you can insulate some risks as you get older by doing proactive planning. And so sometimes people, they look past some of this planning because they don't internalize what the numbers really mean relative to what life is going to look like because they're not 85 years old yet. And that's why I always tell people, one of my favorite proverbs is if you want to know the road ahead, ask the person coming back. And so, while I am not 85 years old, we have clients who are in their 80s and 90s. And so we can walk back down that road and tell you, hey, this is what life actually looks like, not what it says on YouTube, and give you real planning advice based on where life's headed. So don't look past it's a 0.5% to 2% annual rate of return difference, just depending once again on how young you are and your balance. Roth conversion misconceptions. So number one, the 5-year rule. That's the number, other than the number 2 point here. The number one thing people bring up is, oh my gosh, well, I have the 5-year rule. It only applies on gains. So if you convert 100,000, your basis is protected if you're over 59 and a half. Now, if you do it before 59 and a half, we don't typically recommend conversions over 59 and a half. You can do it, but I don't typically recommend it because they got to pay the taxes out of their savings account. Um, which mathematically, makes sense. But we typically say, hey, you can wait till 59 and a half, but the 5-year rule only applies on your, gains. So your basis is still protected. Now, here's another thing I'm going to tell you if you haven't done Roth conversions yet, is if you are concerned that you're going to need to turn around and touch that money, Roth conversions may not be a fit. Liquidity is an aspect with Roth conversions where it's like, hey, we're doing this thinking long term. We want to set aside money also in the planning that if you need income, you need a major purchase, you want to have that money set aside, almost like if you were weeding out, doing an annuity or not. You may not want, and I'll talk about that in a minute, but like you may not want to do an annuity if you have a big purchase. Okay, well, if you know you're going to need all of this money, maybe a Roth conversion isn't a smart idea. So if liquidity is a concern, you have to weigh that option if you know you're going to be dipping into gains in a few years. So you have to think with some foresight, but the 5-year rule just isn't as scary as people think it is. Your basis is good, and as long as you don't touch your gains, you don't have any issues. IRMA charges, people, sometimes people get wrapped up in what if my, healthcare costs and insurance premiums go up with Roth conversions? It's a real concern. We do have to subtract that, from the gains. Now, when we're looking at multiple 6 figures in tax savings, multiple 6 or 7 figures in portfolio gain from tax savings, I think that's worth a trade-off. Do your Medicare, I know that's a month-to-month expense, and once again, we all are conditioned to think in the here and now. But if you really hold up a mirror and you compare it, okay, maybe an IRMA charge isn't as big a deal if you can save, and get 1.5 million in total value. But the other thing I will also impress upon you today, if you've been concerned about that, is the worst case scenario is often less in the future anyway. And so if you don't do Roth conversions, then you get that R&D potentially, and now you're locked into an income that forces that IRMA charge on you, period. And so you also have to be careful because there's a lot of people we meet with that get wrapped up in the IRMA charge today, but they're better off paying IRMA charges for just a few years versus being stuck paying it for 20 or 30 years. Because the other part I didn't put a lot into this today, but when it talks about longevity, I really do believe a lot of us are going to live longer than we anticipate. And so the other part too is you have to think like, hey, what if I live longer than how my parents lived? What if I live past 95? What if I live past 100? Now you have to start building that into the plan too, because that's charges on top that you're locked into and that the government's continuing to get a partnership split. And then the last is just the tax rate fallacy that, rates won't be higher in the future. I harped on that earlier on this, but that's a big, misconception is, oh, I think my taxes will be lower in the future. I mean, maybe, but then we all have bigger fish to fry if that's the case. I just don't believe that to be true. Um, and lastly, just kind of a warning, stop saying only. So once again, the annual tax savings lost by not converting is $60,000 a year. So you wait this year and you don't do anything by December 31st. you just cost yourself $60,000. And you could say, oh, it's only $60,000, but if you had to go buy a $60,000 car tomorrow, you probably wouldn't be excited. You might be excited for a few days with the new car, but writing a $60,000 check would not be fun. So internalize it. Hey, if I had $60,000 get stolen from my bank account tomorrow, how would that make me feel? And the problem is, once again, you don't feel you're not getting robbed of that money today, but you missed that opportunity. And so the average is you're costing yourself 60,000 bucks. What we found is that 60,000 compounded over time is $300,000 in annual portfolio value. So you're costing yourself $360,000 every single year you wait. And I can't tell you how many people I meet with. We put together a full financial plan for them, and they just sit on their hands because it's analysis paralysis, or they do things themselves and they just don't act. And so I would just really impress. I don't care if you're doing it yourself, working with another advisor, get it done. Like, and it doesn't have to be drastic. It may only be 20 or $30,000 you convert this year, but there's going to be a cost, as long as the math makes sense. So just stop saying only when it comes to these annual numbers. So, as I promised earlier, just a free resource if you manage your own money. Um, when I used to do everything by hand, I used this John Hancock fingertip tax guide. So you can just Google John Hancock 2025 tax planning guide. It's condensed here. It's typically more extrapolated than this, but it'll give you every single tax bracket. It'll give you the limit. If you're single and head of household, no matter how you're filing, it gives you the trust limits, it gives you capital gain limits, kitty taxes. It gives you every single thing you could pretty much possibly think of limit wise. And so if you like doing it yourself, this would be a great litmus to like, hey, do the math, bounce it up against this, and if you've got some software or something. Um, and then the second page has those factors for RMDs. So you can roll out and say, okay, based on my age, what's my factor of what RMDs are going to be as well. So this is for the person, once again, you do this yourself. I just thought this would be helpful. A lot of people feel kind of blind. They're Googling things. This is just something you can download as a PDF, have it handy for your use whenever you'd like. So moving in, so if anybody, and maybe nobody on here, and I'm just gonna be speaking to the wind, but if somebody owns a business today or they have real estate or some type of entity, some specialized tax strategies that we focus on are cash balance plans. So this allows a business owner to contribute basically, typically a 401k, you're putting 20,000, 50, 60,000 a year in, SEP IRA 69,000. This allows business owners to actually contribute over $100,000 a year into a retirement plan. And what they're able to do, so example being in this chart, a 60-year-old can put, almost 400,000 bucks in and it's 100% tax deductible. So they immediately save $167,000 in taxes per year. We have several business owners we do this for. And so it's a great place for a business owner to accumulate wealth and get significant tax deductions. And at the same time, how we've designed these is if we meet with somebody who has an estate planning problem, maybe they're going to have estate taxes. One thing using the tax code is we can actually fit, because it's a pension plan, we can fit life insurance inside of the plan. And so what this is actually a real business owner. We took out the name, but they were able to put $400,000 a year into the plan. Half of it was like a traditional IRA or a 401k, 200,000 bucks a year. And then the other half was funding a life insurance policy, fully tax deductible. That then at the end of 5 years, they had a good amount of cash. So we're going to put cash in the grantor trust, and the grantor trust is going to buy the policy out. So now they essentially got a discount on the life insurance, but at 90, they've got 6.7 million to pay the estate taxes. And then on the IRA side, so now they have this death benefit plus the cash value, the tax-free cash value inside the policy, but now they have 2.8 million in an IRA. And then, yes, that's money that's eventually going to be subject to taxes. So then maybe we do some conversions and we do some creative things for the client at that point. But if you're needing a significant tax deduction, this is a unique way that you can do that. We do have a few people that we work with that are over 70. They're kind of in that camp. They still own a business or they have huge real estate holdings and an estate tax problem. And so we've been able to use a plan like this to do some creative tax planning as well. And then the last is, maybe you don't even own a business. Maybe you have a lot of real estate. Who I would be speaking to here is the person who has a huge IRA and they're never going to spend it. They say, "Oh my gosh, I accumulate all this money and the government hoodwinked me. I'm going to get taxed blind. I'm going to put it in a savings account or put it somewhere. Meanwhile, the government gets paid." If you're that person and you own real estate or some type of entity, maybe you do consulting, what we're able to do is we just call it a retirement tax minimization as you can establish a qualified pension plan. We do a transfer of your IRA dollars into the plan. And then what happens is the IRS calls them seasoned dollars. So because all of you, retirement age, if you've had your dollars in an IRA for a period of time, the IRS deems them seasoned, and here's the tax code here at the bottom. And at that point, now what we can do inside that qualified plan, similar to backing up here, is because of the exemptions in the tax code, we can do basically a like Roth conversion inside the plan, use the taxable dollars to switch into life insurance, which has the same similar tax treatment as a Roth IRA so we can switch those dollars from taxable to tax-free without the upfront tax. So like the Roth IRA, there's going to be some tax to get it into a Roth. Well, this we can actually swap it into the life insurance without an upfront tax hit. So there's no taxation to get it into the tax-free bucket because it's seasoned and because it's inside a qualified plan. Once again, this is a good fit for somebody who cannot, let's say you're over 70 and you're pressed against that window between 73 and you can't do Roth conversions, but you have an entity. This is a great fit. This is a great alternative. Or you have an estate tax issue and you need life insurance to pay the estate taxes for your heirs, and you're not going to spend the IRA. And how we effectively do this as tax efficiently as possible. So this is a real client. They had another 690,000 in a brokerage account. We move that into the grantor trust. It's going to grow to 883. And then that grantor trust is going to buy the policy out similar to the cash balance. So it takes actuarial planning. We actually have actuaries that do this planning. It's very specialized. But once again, it's probably not for everybody on this call. But it's an area we work in that we save people multiple six figures to even sometimes seven figures a year in taxes. Um, and then this is just the illustration of what that looked like for this client. So at age 95, their portfolio value would have been 8.1 million at life expectancy. Doing the strategy added at 1.2 million in portfolio value. As you can see, even at 80, it was a net positive. So they would have had 3.8 million. It went to almost 4.5. And then the tax savings on that, we saved this person 1.3 million in total taxes over their life expectancy through the plan. Now, a lot of that tax savings is upfront. It's less spread out as a Roth conversion. So once again, maybe I'm speaking to the wind here, but maybe you also know somebody who's very successful who's getting crushed in taxes. You can pass this along to them because it's an area we specialize in that you probably don't find just walking along the street. Some other just kind of tax hacks, qualified charitable distributions. So if you're already giving money to church, charity, once you hit RMD age, you can take that money directly from your IRA and give it to the 501(c)(3). Has to be done by December 31st, and it will satisfy your RMD requirement. And there's a $105,000 annual limit. So you have up to 105,000 a year. So what I'll just tell you, another reason maybe you don't need to do Roth conversions is if you typically give $30,000 a year and your RMD is 30,000, well then you don't have an RMD tax risk because you've already been given that money. So that's another thing we factor into planning is if somebody gives money routinely, that's going to be a net positive subtraction, from their RMD schedule. So they aren't as exposed to that risk and it reduces their AGI. So qualified charitable distributions got to be directly from the IRA. It can't go from your IRA to your bank account. It has to go from the IRA to the 501(c)(3) via check or transfer. So just keep that in mind. QLAC, I'll just preface, this is typically a fit for 1 out of 10 people we meet with, but it is in the tax code. That's called a qualified longevity annuity contract. It's IRS section 401(a)(9). And essentially what it allows you to do is it's a specialized annuity contract. The limit, if you're married, 400,000 per household or $200,000 per person that you can fund. And what it does is that $200,000, if you had $1 million, 20% of it now gets taken off of your RMD schedule with that factor until the age of 85. So it's a way that you can defer RMDs, get it off of your RMD schedule. Once again, this is a great tool for somebody who's at that age 70 to 73 window. They can't really do Roth conversions. They're kind of handcuffed and they just want to defer the taxes. So the key benefits is that deferral, kicking the RMD can down the road till age 85. Another key benefit, everybody always says annuities have fees. It actually has no fees, so it's very cost effective. Could be a great long-term care tool. It has an extremely high payout after age 85. So that's kind of the double-edged sword, is it's great for like short-term tax planning. But then what happens is you're going to start getting like 36% a year of the whatever you put in. So eventually you're going to end up paying the taxes back anyway, and the government knows that. But if you have concerns about care and long-term care insurance is too expensive for you, you don't want to pay the bill, you don't want to be use it or lose it, you don't want to buy some life insurance policy that's super expensive to get long-term care, this could be a great avenue. This could be another way to look at it. Another nice thing from a legacy standpoint, this is a question we get, is okay, if something happens to me before 85 or, after the fact, what happens? Your kids are going to inherit the money like a normal IRA, which they're going to be subject to the 10-year rule, but they would inherit it. It's not like a typical, an old-fashioned annuity or a pension where the money's gone forever. So once again, very specialized. I say 1 out of 10, maybe it's 2 out of 10. It's just not as common. You got to be willing to commit the money, but it is very cost effective, and it does sometimes work well from a tax perspective as well. Risk tolerance, I'm not gonna, we're a little bit behind on time today anyway. I'm not gonna go into specifics of how you should design your portfolio because one, that's probably not compliant of me to do, not knowing your situation. But everybody's unique. And so we have a free risk tolerance tool that gives you a risk tolerance score similar to like a speed limit. So it'll help you understand, hey, how fast am I driving with my portfolio? And it'll help you say, okay, and I always give the analogy, it's like going to an eye doctor and they say, look through lens 1 or 2, and they kind of help you dial it in. That's how the questions work when you answer it. It probably takes 60 seconds to answer those questions, but it'll help you gauge your risk tolerance so you can scan that and get access to it. But ultimately, you want to design your portfolio to align with your risk score and combine that with your goals to help you back into a long-term investment strategy that matches it. We are not short-term stock pickers for people. We think long-term, what's going to work in the long term, institutionalized thinking, like, hey, how are we going to get good returns over a sustainable period of time? Then lastly, if you do things yourself, just keep it simple. Complexity is the enemy of confidence and execution. And, what I'll tell you, we like alternative investments. We do sophisticated things for people. That tax thing might have overwhelmed you. But at the end of the day, like if you're doing stuff yourself, maybe an index fund or something is easier for you and it's less risk, and it's easier to manage. So sometimes you don't have to get super complex to have success and lower your risk tolerance. So quickly, I'm not going to go, I'm going to spend a whole day on this, but another kind of hot button issue is annuities. Are they a great strategy or are they a retirement scam? So let's just quickly understand the different types of annuities. So there's fixed annuities, there's indexed annuities, there's the RILA, which it's called a registered index-linked annuity, and then there's variable annuities. So you can take a picture of this too if you've had anybody approaching you for annuities. This will help you give a quick idea of how they work. So fixed annuities are very much like a CD in the sense that you're going to the insurance company for the guarantee, not a bank. You're not getting FDIC insurance per se, but they don't have a fee because that's the big thing. Is everybody says annuities have a lot of fees. They don't have a fee. And what you're able to do is for 1 to 5 years, sometimes they go up to 10 years, but typically it's 1 to 5 years. You commit the money and you get a guaranteed interest rate over a period of time. And so let's say you put in $100,000, they may say, hey, you're guaranteed 5.3% for the next 5 years, no market risk. You're going to get that. And at the end of the 5 years, you can move your money out. Typically, you can take 10% a year out without a penalty, without losing the benefits. An indexed annuity, you're mirroring some type of index and they're going to give you a cap. So they'll say, hey, we're going to let you participate in the S&P 500. But if it goes up 10%, we're going to cap you at 8%. Typically, there's a string attached. And the reason they do that is because typically the income guarantees on them are very good if you want income, or they have a what's called a floor. And so it has a 0% floor, so you can't lose money if the market goes down. So you're not exposed to market risk on the downside. And so they cap you on the upside. Surrender period, the time you got to keep the money in there is typically 7 to 12 years, but you can get 10% a year out, if you need to without any strings attached. How the RILA, the registered index linked annuity works, also typically doesn't have a fee. What you're doing is you're actually getting to participate in the S&P, for example, or some type of indice. So what a lot of them are doing right now is they'll give you 105 or 115% of what the S&P 500 does. And so if it grows 10%, you get 10.5%, for example. And it's a 6 year period that the money's in there. But the trade-off is they'll actually protect you up to, some of them go up to minus 30 or beyond percent of a buffer that they'll protect you. So over that 6 year period, if the market was down, 15% and you had a minus 20% buffer, you actually don't lose any money on your principal. So you're protected over that period of time. But meanwhile, if the market would have gone up, you would have got the full growth of the S&P over that period of time. Fun fact is over a 6 year period, the S&P 500 has never been down more than minus 15% over a 6 year period. So typically you don't need more than a, 20% buffer. Yeah, that's kind of overkill. And then variable annuities. Annuities get a bad rap because of variable annuities, because as you can see, the typical fees on them are 1.5 to 3%, and you're still in a 7 to 10 year period. Variable annuities is kind of a dying product. You may have a variable annuity today, so if you do, I'm sorry to offend you, but it could be a really good product because 20 years ago, the variable annuities were, even though they were expensive, they had really good benefits. But what's happened is these companies have innovated. I say the annuity market's kind of like the iPhone. They update them every year. The costs typically go down, the benefits go up. They have to engineer new things to win the business. And variable annuities are just kind of on the fringe because the writing on the wall is suitability wise, you're better off having other different investment allocations than paying 1.5% for some type of annuity that has below average investment options. So we replace a lot of variable annuities. I mean, maybe that's my bias here. We get a lot of people out of variable annuities. Um, but annuities can be good or bad, just depends. But they all typically have that 10% free withdrawal. Reasons not to buy in an annuity, large liquidity needs. So this could be major purchases, like I talked about earlier. You have real estate or something you need to buy with your real estate or with your assets. The other part is Roth conversions. It just chaps me to no end when I meet with somebody somebody sold them a bunch of annuities, but now they're in that surrender period, and we can't do Roth conversions. That really upsets me. And so, if you need to do tax planning, you have to have the money set aside to do the tax planning and not on that annuity surrender. Now, there are some annuities that allow you to do conversions, and that can be creative. People are selling those, but you got to be real careful if those are suitable for you or not. There's only two or three that are really worth anything. But nine times out of 10, we want to keep that money free and clear. Like we got to do conversions, we got to get it moved over. So be careful not to lock your money up. Risk tolerance, if you're super aggressive, you're going to hate annuities. You're doing it for some type of trade-off. Yes, the Riley, you get the full growth of the market, but you're always going to think you were giving up something. You could do an alternative, like we do structured notes. That's an alternative investment, works similar, has a little bit more risk to it, but a little bit more upside as well, some downside protection. So you don't have to do an annuity. So if you're super aggressive, probably shouldn't buy an annuity. And then no additional income need. Another thing just blows my mind is people that get sold income annuities that don't need income and they're paying 1.5% of a fee for income they don't need. So, this sounds like common sense, but if you know your day-to-day income needs are met, don't take the trap. Don't buy some annuity that's going to lock your money up to give you an income benefit that you don't need, that you're going to pay 1.5% for. So just be careful. That's another thing we replace pretty often are people stuck in annuities for income they don't need, and we save them several $1,000s a year in fees. Um, Reasons to buy an annuity. Number one, I mean, I know I'm beating an old drum here with taxes, but tax benefits. You can take some of that CD money that you're getting taxed at ordinary income on that interest growth. I mean, I've had people that have $1 million in cash, and when the interest rates were 4%, 5% on their CD, they were getting a pretty good ordinary income tax bill, on those gains from those CDs. So what you're able to do is you're able to move some of that money into some type of maybe even fixed annuity, get a guaranteed interest rate, but annuities have unique tax treatment. They get tax deferral. So what you're able to do is get that money in there, get compounded growth on a tax deferred basis. If anybody owns real estate or has owned real estate, you may have heard of what's called a 1031 exchange, where you can exchange, if you sell an investment property, you can exchange the gains into another one without a tax hit. Well, annuities and insurance work the same way, where you can defer those taxes into another annuity. So if you get to the end of the 5 years or the 10 years, you can continue to kick the can down the road. You can actually even do that. There's what's called trust-owned annuities, and you can use a trust or something from an estate planning perspective to skip generations and get money to the next generation tax efficiently as well. Number two, you can let the insurance company pay your conversion taxes. Once again, I put an asterisk behind this. There's companies, they'll give you a 16% bonus. So example being you have $100,000, you get 16,000 from the insurance company. Well, if you can imagine, if you have multiple hundred thousands of dollars and you get a pretty good chunk of a bonus, what you're able to do is do a conversion inside the annuity that does not have a fee. And essentially, the math would say sometimes that the insurance company, that bonus they gave you protects your principal. So you can do the conversion inside of it, and you never really took a hit on the tax bill. The insurance company essentially paid it for you. Once again, you got to do the math on that. We have people, we've done it, but it's most of the people we do conversions with, it's just in a normal IRA and Roth IRA accounts that we're going back and forth. Risk tolerance, you can replace bonds with annuities and lower your portfolio risk. I will show you an actual case study of that. And you can swap out your index funds into a RILA. So if you have like all index funds, you could literally just swap them into a RILA for downside protection. I'll show you a case study of that as well. Income need, obviously, if you need a percentage of income for the rest of your life, you could use an annuity for that pretty cost effectively. And then fees, once again, kind of the buzzword with annuities is that they're expensive. My experience is we actually use it as a way to lower fees. People that are paying, 1%, 1.5% for an index fund or some type of fund that or bonds that we can replace in the financial plan says it's suitable to do so and it's in their best interests. So we can essentially replace certain asset classes and slash fees at the same time. Apologize if I'm running over as well. Hopefully this is valuable. So just a case study. This was a 65-year-old we worked with who had 400,000 in cash. His CD yield or his, high interest savings and CD yields were 3.5%. At the time, taxable interest on his 400 was 14,000 a year, and he was paying $3,000 a year at his tax rate on those on that taxable interest. So his net return was 2.75%. After what we found, because we also were doing an IRA and other things with him, inside the financial plan, we took 200,000 of that 400, put it into a 3-year fixed annuity. He was guaranteed 5.3% on that 200,000, plus he's still getting the 3.5 on the other 200,000. So his total interest went to 17,600, but then we cut the taxable interest in half to 7,000. Taxes on cash 1,500. So net rate of return went from 2.75 to 4.01 just on his cash holdings. So it's a way that we can add some return on low yielding cash. Another example, somebody with $1 million in investments, different various accounts. They had $500,000 in large cap mutual funds, which was basically the S&P 500. They're paying 0.65% of fund fees. That's $3,200 a year. The risk on that was 16%, which means they could go up 16% or down 16%. We took that. We said, hey, based on the plan, the suitable amount, because they need to do some Roth conversions, so we couldn't put it all. 250,000 of that 500 we moved into a RILA. The participation was 107%, so they get 107, if it goes up 10, they get 10.7, but then they're protected up to that minus 15%, which is the typical, maximum 6-year risk on that type of holding. But then we cut the risk in half. So it went from 16% to 7%. And then we also likewise cut the fee in half. So it was a way that we could reduce the risk, get a little bit of upside, and reduce their fees at the exact same time. And then this was a real case study. So using that software that I allowed you to scan, we had somebody, their current portfolio had a risk, they were pretty pretty moderate. They had a risk score of 54. They had $1 million. Basically, the allocation was 76% or 66-34 with stocks and bonds. And what we did was we made an adjustment. And if you compare it to the S&P has obviously more risk. It's going to get more gain. But we took that allocation. In their case, it was suitable to do a fixed indexed annuity. And we replaced the bonds with that. And what we found was it was going to add rate of return while reducing risk in the portfolio. Once again, that's not every single client we work with. Sometimes it's not a fit based on other variables of planning. But when people do tell you you could strip out bonds, put annuities, if all the stars align, it can be a positive to your planning. And so ultimately, this is what planning done properly looks like. So this is a good client of ours. So there's a lot of variables. So I don't have all the little buttons we have going on. As you can see, they wanted to buy some real estate and build a shop. And they had some company stock. But planning done well is one, 99% chance of success, which means you're basically bulletproof from our software standpoint because we're showing reduced growth rates. But then they're saving 2.5 million. But like I showed earlier, that 2.5 million in taxes is adding 5.1 million in portfolio growth. So that's what planning done properly looks like. And once again, if you do it yourself, just be careful. Like, just make sure you do, like, put the time in to test these variables of, okay, what's my tax savings? Because as you can see, they're still paying taxes. They're going to pay 3.2 million in taxes over time. But they're also, going to get a gain, on those tax savings, and it's going to add 5 million to their portfolio value. So make sure to test those things. No estate plan. Once again, I'm not going to harp on this today, but just by not having anything in place, there's a risk. There's costs of things going to probate. So even if you just have $500,000, it's going to get very expensive if you have nothing in place. And that's why when you walk into the attorney's office and they say it's going to be $5,000, well, they know that they're saving you, in theory, $30,000 versus you having nothing. They know the numbers. They're salesmen in disguise. And so just make sure you have something in place. when it comes to your estate plan, either pay the bill or use some type of resource like we have. Just a free gift for joining. I appreciate you guys staying a few minutes over with me. But for anybody who's interested, who got value out of today and they're concerned about taxes, we're just going to give you a free Roth conversion roadmap. And so, essentially what we can do is we can get just a few of the variables we need from you to test, what your account balance is, your age, Social Security, things of that nature. Just a few questions we can diagnose and say, hey, what does your conversion window look like? What I will tell you is these numbers are not, they're not fixed. So every year it's going to change. So when we're meeting with people, we're updating things every year. So this isn't something you're going to get to just sit around and not update every year, but we can give you kind of a baseline to work off and test what tax bracket is best for you based on your income. So that's something we're going to give you. We'll also test the QLAC. We'll test QCDs if you give money, and we'll do the RMD projections. That's just a free gift. I'll give you a QR code you can scan to get access to that after this. And then if you're saying, hey, this seems like a lot, or hey, I own a business and I need some of the complex stuff, we do white glove planning. So we do all this stuff for 0.85% or less. So a lot of people are paying 1.5% if they work with a financial advisor. So we do financial planning, we do estate planning, we do wealth management, we do tax planning. We do have an outlet where you can establish a will and a trust. Our attorney can help guide you through those things. If she sits with you, that is like an additional fee, just like if you're filing your taxes with us, that's also an additional cost for our CPA to do your taxes. But as far as the Roth conversions, everything that comes inside of whatever we're charging. The reason I say 0.85% or less is we use annuities to discount fees. So if an annuity is suitable, the insurance company pays us 1% a year for the time you have it. We let them pay a percentage of your fee, and we use that as a discount to you, let them pay the bill as much as possible. And so with our white glove planning, you get Roth conversions, tailored financial planning, sophisticated wealth management, and will and trust setup access on top of a multitude of other things. So if you'd like somebody to do all the work for you, we do that as well. So yeah, I appreciate you guys joining today. Here's the QR code. You can scan for a free Roth roadmap or to start a white glove conversation. You can literally check the box on whichever one you would like. You can either say free Roth roadmap or glove conversation. That's important because I'll just tell you, like, okay, if you want the Roth roadmap, we're not going to do this crazy in-depth fact finder. We're not going to, wine and dine and ask you, last time you saw your grandkids. And it's literally just going to be, hey, give me these set facts and we're going to get the information to you. There's going to be zero sales pitch. There's going to be zero of that. It's just literally like, hey, let's get you the details because we're promising you something for free. And then the white glove conversation, we're going to go more in depth. Like, tell me about your family, tell me about the other variables, because we have to look at everything from a financial planning standpoint, especially if we're going to do some estate planning or file your taxes. We have to know more. We can't just go an inch deep with you. So yeah, if this is of interest, if you'd like a free Roth roadmap, just scan the QR code, or if you'd like for us to do the work for you, and you see the value in what you do, you can elect that and we'll start that conversation. So appreciate you joining here. Here's the fine print, the disclosures that, annuities aren't for everybody and you can't convert and not have taxes and things of that nature. So just keep that in mind. But appreciate everybody joining. This has been a good time. Appreciate everybody hanging around and have a great rest of your day.